every night at exactly midnight, something happens to your money. Not a glitch, not a fee. Something the bank does on purpose, has always done, and has never once sent you a letter about. And by the time you finish this video, you'll never look at your bank account the same way again. Let me introduce you to Marcus. Marcus is 34, works in logistics, has $6,200 sitting in his Chase savings account. He put it there because that's what responsible people do. He sleeps well knowing that money is safe. Here's the part Marcus doesn't know. The second he closed his eyes last night, his bank took most of that $6,200, lent it to a stranger, charged that stranger 7% interest, and handed Marcus back 4 cents. Not 4%, 4 cents. That's not a typo. That's Tuesday. My name is Jack, and I've spent a genuinely embarrassing amount of time reading the fine print that banks are betting you'll never read. And here's the thing, this isn't a conspiracy. It's not illegal. It's not even hidden exactly. It's just never explained in a way that makes you realize what's actually happening to your money every single night while you sleep. So today, we're going inside the machine. We're going to follow Marcus's $6,200 from the moment he deposits it to the moment the bank turns it into something that would genuinely shock him. We're going to look at the numbers, the real numbers, and by the end, I'm going to show you exactly what to do so you stop being the one funding everyone else's wealth while yours sits still. If that sounds like a video worth watching, hit subscribe because this is the stuff they really should have taught in school and didn't. Let's start at the very beginning, the moment Marcus hands the bank his money.
Here's what most people think happens when they deposit money. They picture a vault, big steel door, stacks of cash with their name on it, like a giant safe deposit box where their money sits, waiting, untouched, until they need it back. That picture is wrong, completely, fundamentally wrong, and the bank knows you picture it that way. They're fine with it. Here's what actually happens. The moment Marcus deposits $6,200, that money legally stops being his in the traditional sense. It becomes a loan. Marcus just became an unsecured creditor of JP Morgan Chase. The bank now owes him $6,200, and like any borrower, they're going to use that money before they pay it back. This isn't a new trick. This isn't something invented by modern Wall Street. This is how banking has worked for literally 700 years, since the merchants of Venice figured out they could lend the same gold coin to 3 different people at the same time. It has a name, fractional reserve banking. Here's how it works. The government tells banks they need to keep a fraction of deposits on hand, reserve requirements, historically around 10%. But here's the part that gets wild. In March 2020, the Federal Reserve dropped the reserve requirement to 0. Not 5%, not 2%, 0. That means a bank like Chase is technically not required to keep a single dollar of Marcus's deposit in reserve. Now, in practice, banks keep more than 0. They're not completely reckless, but the legal floor is the floor, and 0 is the floor. So what are they doing with the rest? Buckle up, because this is where it gets interesting. Let's follow Marcus's $6,200 and watch what happens to it. The bank takes that deposit and lends out, say, $5,500 of it to a woman named Linda. Linda's buying a used car, 7.5% interest rate, 60-month loan. Linda takes that $5,500 and buys the car. The seller deposits the $5,500 into their bank account. Now that bank has a new deposit, and they lend out most of that too, to someone else, who deposits it somewhere else, who lends it out again. Economists call this the money multiplier. One real dollar deposited once can ripple through the banking system and become several dollars of loans. Marcus's $6,200 didn't just sit there. It became part of a chain that funds mortgages, car loans, business credit lines, student debt, and credit cards charging 24% interest to people who thought they were just buying groceries on a bad month. And what does Marcus get for being the starting point of this entire chain? Right now, the national average savings account interest rate is 0.45%. On $6,200, that's $27.90 a year. Meanwhile, Chase reported over $49 billion in net income last year. A meaningful chunk of that profit comes directly from the spread, the gap between what they pay Marcus and what they charge Linda. They pay Marcus 0.45%, they charge Linda 7.5%. The difference is the game, and Marcus is the one funding it. Now here's the question that should be bouncing around in your head right now. Is this legal? Yes. Is it disclosed? Technically. Is it ever explained to you in plain English at account opening? You already know the answer. But lending to car buyers is just one thing banks do with your money at night. There's a whole other market most people have never heard of, and it only operates while you're asleep. It's called the federal funds market, and it's where banks lend money to each other, overnight. Here's why it exists. At the end of every business day, some banks have more cash than they need. Others are a little short. Instead of letting that excess cash just sit there doing nothing, the banks with extra lend it overnight to the banks that need it. They charge interest for that overnight loan. The rate they charge is the federal funds rate, the same rate you hear about every time the Fed makes a decision. So on any given night, your deposit might not just be funding Linda's car, it might be part of the liquidity pool the bank is lending to another bank, overnight, for profit, back by morning before you check your balance. This is entirely normal. It happens every single night across thousands of banks, and it is completely invisible to Marcus. His app shows $6,200. It always shows $6,200. The number never moves. But underneath that number, the bank is playing a continuous, sophisticated, highly profitable game using his money as a chip. And that's before we even talk about what banks do with the really big deposits.
When you have a really large deposit, we're talking businesses, institutions, high net worth clients. Banks don't just park that money in overnight loans. They put it to work in the bond market, in mortgage-backed securities, in treasury bills, in financial instruments with names that sound like they were designed specifically to make your eyes glaze over. And that's the point. Here's a simple version of what's happening. Banks borrow cheap from you at 0.45% and invest expensive in assets returning 4%, 5%, sometimes more. The spread between those two numbers is called the net interest margin, and it is the single most important number in banking profitability. JP Morgan's net interest income alone was over $89 billion last year. Let that land for a second. $89 billion, generated primarily from the gap between what they pay depositors and what they earn on investments and loans. And the depositors, the Marcuses of the world, are the raw material that makes the whole machine run. Now, here's where I want to be fair, because this isn't entirely a villain story. Banks serve a real function. They take small, scattered deposits and pool them into capital that funds businesses, mortgages, and infrastructure. The economy genuinely needs that. Your neighbor's small business loan, your cousin's mortgage, those exist because banks aggregate deposits and deploy them. The problem isn't the system existing. The problem is that the people at the bottom of the chain, the everyday depositors, are the last to know how the chain works and the last to benefit from it. Marcus is the engine, and he's being paid engine room wages while the captain collects all the upside. So what does Marcus actually do about this? Here's the part the bank is genuinely hoping you never reach, because everything we're about to cover is perfectly legal, widely available, and completely ignored by the majority of American depositors. First, stop leaving money in a standard savings account if you don't have to. The national average savings rate is 0.45%. The best high-yield savings accounts right now are paying 4.5% to 5%. That's not a small difference. On Marcus's $6,200, the standard account earns him $27 a year. A high-yield account earns him around $280, 10 times more, for doing nothing differently except choosing a different account. Your bank is not going to tell you this. They profit from your inertia. Second, look at treasury bills. Short-term T-bills are currently paying around 4.5% to 5.2%. They're backed by the US government, which makes them essentially the safest investment on earth. And the interest is exempt from state income tax, a bonus your savings account doesn't give you. You can buy them directly at treasurydirect.gov, without a broker, without fees, without a minimum balance that would make your eyes water. Third, Understand what a money market fund actually is. Not a money market account at your bank, that's different and usually pays less. A money market fund, offered by brokerages like Fidelity or Vanguard, invests in short-term government debt and currently yields around 4.5% to 5%. Your money stays liquid, you can pull it out, and it earns dramatically more than a standard savings account. Fourth, if you have an emergency fund sitting untouched for months, it's not just safe, it's slowly losing ground. Inflation at even 3% quietly eats the purchasing power of money sitting at 0.45%. Your $6,200 today is worth less next year in real terms. Moving it to a high-yield account or T-bills doesn't make you a Wall Street trader. It makes you someone who stopped voluntarily donating to your bank's profit margin. None of this is complicated. None of it requires a financial advisor. It just requires knowing that the option exists, which is exactly what your Marcus's bank was counting on him never finding out.
Here's the truth. Nobody puts in a brochure. Banks are not storing your money. They are using it. Every night while you sleep, that number on your screen is funding loans, overnight lending markets, bond investments, and profit margins that have nothing to do with you. That's not a crime. It's not even surprising once you understand how the system works. The crime, if you want to call it that, is that nobody ever explained the system to you. They handed you a debit card, a routing number, and a welcome bonus, and quietly assumed you'd never ask what happens after midnight. Marcus is still asleep. His app still says $6,200, and his bank is still in the market. The only question is whether you're going to keep being Marcus, or whether you're going to take 5 minutes this week and move your money somewhere that actually works for you instead of against you. Because the bank figured out a long time ago how to make your money work overnight. It's about time you did too. If this video connected some dots for you, do me a favor and hit that subscribe button, because what we just covered is only one piece of how the financial system is quietly running in the background of your life. The next video we're breaking down is something even closer to home. It's about the credit score threshold banks actually care about, not the number they tell you to chase, the real number, the one that changes what you get offered, what you get denied, and how much everything costs you for the rest of your life. That one goes up next. I'll see you there.